Ladies and gentlemen, have you ever dreamt of retiring overseas, basking in the warm weather, the local cuisine, the friendly people, and doing it all on a fraction of what you would need to retire here in the US or in most other Western countries? Well, it's certainly possible in the Philippines, where for 8 to 1200 a month, it's possible to live a comfortable retired life. Now, I actually have three stocks in my portfolio that I think would help someone achieve this wonderful, wonderful dream, and I'm going to share them with you today. Okay? The first stock on the list is none other than Altria Group Inc., ticker symbol MO. This is the tobacco giant. They have the famous Marlboro brand of cigarettes, as well as many other smokeless options and chewing tobacco brands and more budget-friendly brands under their umbrella. They're also working on trying to acquire the vaping company Enjoy, as well as holding a 10% stake in Anheuser-Busch InBev. Now, Altria is a dividend king with a yield of over 8% at current prices. They've been increasing their dividend basically since before I was born. Now, even the recent dividend increases after such a long history are not anything necessarily to sneeze at. Mid-single digit bump here in as of 2022. All right, so definitely not just doing the bare minimum. They're not just doing a penny every time. They target always to do 80% of their adjusted EPS as dividends. They spit out a ton of free cash flow, and they just return most of that cash to you. So that honestly makes them pretty attractive. But there's one more bonus thing that I like about this company. They have a pretty good track record over the last decade of just doing buybacks here and there and reducing their share count. Reducing the number of partners in the business increases the amount of cash flow that's available to give out to any of the remaining partners in the business. So at the moment, with their yield above 8%, anytime they buy back a share, they save 8% going forward on that dividend. So recently there was a $1 billion buyback announced, and if they did the $1 billion worth of buybacks all at today's prices, that would save them $80 million per year on dividends on those shares. So something to keep in mind with Altria. I don't think that vices like smoking or vaping are going anywhere anytime soon, and I think that you can probably rely on these guys to keep on paying out a hefty dividend for years to come. Now, before I get into the second company on this list, I definitely want to encourage everybody to hit the like button, drop a comment like The Undertaker dropping mankind off of Hell in a Cell. Do me a solid, subscribe to the channel if you want to engage in more of these interesting conversations around finances and investing. So, without any more stalling, number 2 on the list is the Comcast Corporation. This company is a juggernaut in entertainment and broadband, okay? They have a legacy cable business that still, has quite a large presence over millions and millions of households, and they have the streaming service Peacock, as well as 33% stake in Hulu that they co-own with Disney. All right. Now, interesting thing with Comcast, their cable communications business, which is 52% of revenue and 76% of adjusted EBITDA, includes their broadband service. Now, I almost view their broadband service as basically a public utility at this point, especially with all the work from home and such that came about due to the pandemic. people really cannot do without broadband internet. And in a lot of places, Comcast is pretty much the only good option in town. I've certainly lived in places where you either had to get Comcast or like crappy satellite. And honestly, I don't see Comcast going anywhere anytime soon. And as a bonus, they have the streaming services. Now, Peacock is the place to watch one of the most beloved shows of all time, The Office US. And I've known people in the past who kept certain streaming services around just specifically because they like watching The Office on a regular basis. So they own that. They own Universal Studios. They're all over the entertainment space, the streaming space, and they have all of this supported on the foundation of something that's basically got the stability of a public utility. So that mix makes for a pretty compelling business. But what's even more compelling is this growing dividend, okay? And if you look over the last 10 years, they've done a pretty good job of reducing the overall share count of the company. Now, the dividend has been growing since 2017. There was a cut between 2016 and 2017 with Comcast, but as of late, it has been growing and growing at a pretty good rate, okay? Definitely looks like the last couple have been in the high single-digit range as a percentage, and their adjusted EPS is almost 3 times what they're paying out in dividends. So the dividend seems to me to be well covered. Based on adjusted EPS, their PE ratio would be closer to like a 10 or so. The adjustments typically are for sort of large one-time non-recurring things that they don't expect to repeat in the future. So that's something to keep in mind with Comcast. Now, company number 3 is another company that I don't think is going anywhere anytime soon, but it has been beaten up a little bit as of late on their share price, and that's Walgreens Boots Alliance. Okay? So who hasn't ever gone to a Walgreens? Now, these guys combine a solid starting yield in the mid-single digits, along with a fairly steady growth rate. Now, the recent growth is low single digits and nothing to write home about, but they also do have some growth plans in the works going forward. And I just want to point out that they are currently trading for basically book value, okay? So their total equity is about $29.5 billion. Their market cap's about 31. So it's pretty unusual for a company like Walgreens, I would say, to be trading so close to their book value. Now, they did recently have to pay out like $6 billion for some kind of opioid lawsuit. They've been in the news because of this certain type of pill and their view on it, and the California governor popping off against them instead of taking responsibility and pushing things politically. He decided that he wanted to make Walgreens the bad guy in that situation. Walgreens just had to make a business decision with regards to that. But overall, I think when you combine their good growing dividend with their growth plans that they have with their health services, and the fact that they have done some buybacks in recent years, though it has slowed down considerably, I think that there is definitely room for this already beefy dividend yield to grow over time and really be a core position that pays a really, really hefty amount to its shareholders. Now, when it comes to how these can fit in with an objective like retiring overseas, I think that you would want a combination of yield, right? You want something that, starts paying straight away, but you also want there to be some type of growth too. And you want a combination of companies that are in different areas of the economy that all have a different path to growth, a certain amount of defensiveness and stability. You certainly wouldn't want to retire on a company that's cutting your dividend in any sort of way. So I think that the reliability and the long-term prospects for these three dividend companies make them an interesting combination to work towards something like an overseas retirement. So let me know what you think. Take it easy and have another manic Monday.